Hello and welcome to Insights from the PM's Desk. I'm Justin Plouffe, Deputy Chief Investment Officer for Global Credit at Carlyle. In this episode, we're going to wrap up 2023, including the major macroeconomic trends and how they affected the private credit markets. The first major trend was definitely the higher for longer consensus in interest rates. We saw that in short-term rates, which are now expected to be above 5%, at least for the next 12 months. We also saw it across the yield curve, where we saw a full shift up across maturities. Now, the major issue of 2022 was inflation, and that abated significantly. Not quite down to the 2% target, but well on its way. Maybe the biggest story of 2023 was the recession that never happened. The United States economy continued to be strong, showing significant growth. Why was that? Well, it was the consumer. Real wages ticked into positive territory, and the job market continued to be very strong with high openings and low unemployment. So what did that mean for the private credit markets? Well, first of all, because of higher rates, yields remain elevated. Simply put, we are being paid more than at any time in the past decade for the risks that we take. The maturity wall actually got pushed out during the course of 2023 as companies dealt with their short-term issues. This means we have a good 2 to 3 years to deal with problem credits. And default rates never achieved the levels that most prognosticators predicted at the beginning of the year, remaining well below historical averages. There was one area of concern in 2023, and that was interest coverage ratios. If we project current rates forward through the next year, we are likely to see some companies get to that 1.0 level, and we are very, very focused on that as we evaluate our portfolio. Finally, there was one trend that did continue from 2022, and that was the bifurcation between the haves and have-nots in private credit. BB credits traded something like 800 to 900 basis points tighter than CCC credits. What this means is that those troubled companies cannot go to the regular way direct lending or leverage loan markets to refinance their capital stack. They will need a bespoke capital solution, asset-based lending, or even a private securitization to meet their capital needs. So to sum things up, higher interest rates and low default rates drove really strong performance for private credit throughout the year. This was in the backdrop of a surprisingly strong economy driven by the consumer. As we move into 2024, we think there'll be ample opportunity for private credit to deploy, especially in bespoke capital solutions. On the next episode, we're going to give you our outlook for 2024. But until then, have a happy holiday, and thanks again for tuning in to Insights from the PM's Desk.